人のこと大事にしないといけない。手からやるってやばい言ったのに。力にね、くれようとしてるんだなっていう。落とすが分かんない時もあるね。
The recording has stopped.
Shall we start? Shall we go the forum? Like this, so. Okay, so good morning, everyone.
Good morning. Good morning.
Good morning.
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 Good morning.
So hope you had a lovely week last week. Enjoy your tests. Just a joke. Just for starting. So we've got a pretty busy session today, going through the last two cases. And starting with Mr. Wells. so on international taxation for individuals. So I think we should probably first directly with people in charge. So can you just maybe explain who would be the rapporteur for this case, so that we've got person in front of us?
I'm the reporter I'm not the reporter, sorry. I was the client. I'm sorry.
Okay, so Barbara, you were the client. You're Mrs. Wells.
Yes.
Okay.
So I'm Mrs. Wells. I'm a successful businesswoman, a French businesswoman. And my company, which is a French company, has just sent me to Russia to manage their branch there. So I moved with my husband and my two children to Russia on March of 2019. I moved to Moscow. And for the first few months, I rented an apartment because I wanted to get to know the city and everything. And then I bought a luxury apartment to live with my family there. But as I work in a French company and I keep coming back to France, I decided to keep my apartment in Paris as well. On 2019, I spent approximately 6 months and a half in France and the other period in Russia. And I would like to know where my income tax for 2019 should be taxed. Where am I resident from?
A very good question, indeed. So, who are supposed to be your counsel?
Mariam and I.
It's me and Alisa.
Okay. Hi, Elisa. So, will you start?
So in order to consider Mrs. Wells' situation, my partner and I, we will go through all the relevant articles from the different codes and conventions step by step, starting with the French domestic tax code, as Mrs. Wells is a French national. We will then move on to Article 4 of the OECD tax convention, as that's the basic tax model for all the conventions. And then finally, we will be discussing the double tax treaty between France and Russia. So starting with Article 4B of the French tax code, which states that an individual is deemed having their domicile for tax purposes in France if any of these three alternative criteria is met. 4B1, Article 4B1, the individual has their home in France or has their principal place of abode in France. From what we know, Mrs. Wells has maintained her household in France, and that was her principal house before she moved to Russia. But however, and that makes Mrs. Wealth eligible to be taxed in France. However, there's a problem, like there might be an issue with her center of vital interest, as her family moved with her. So it could be argued that since her family moved to Russia, her center of vital interest is also in Russia. So to deal with that, we will be moving to Article 4B2. So Article 4B, according to Article 4B2, an individual is considered to be taxed in France if they carry out a professional, non-secondary activity in France. As we know, Mrs. Wells can fall under this article, as she has spent more than half part of the year in France for professional activities. And as mentioned before, she has a permanent house in France for the same purposes, because she has to come back and forth for her professional activities. However, there is some contradiction again, because she has also bought a permanent house in Russia, and as mentioned before, it can be argued that her center of vital interest may be in Russia too, as her family is there. So there might be a risk of double taxation. So we will now look at the OECD Model Convention for more clarity.
So according to Article 4, paragraph 2a, it states that an individual shall be deemed to be a resident only of that state in which he has a permanent home available to him. So in order to determine where Mrs. Wells has her permanent home, a definition is needed at first. So We will have a look on the commentary of the OECD. And according to the commentary, it is a residence where an individual owns or possesses a home. It must be of permanent, so it must be of permanent use, not only for short duration. And it doesn't matter whether the house, it's a house or an apartment belonging or rented. However, the permanence is essential, so the dwelling must be available to him all time continuously. Applying that to Mrs. Wells' case, we can state that she rents an apartment on March 1st in Russia, and afterwards she's even buying one. However, she keeps her French apartment since having business back in France. So she goes back and forth, and she spends in France 6.5 months and in Russia 5.5 months in 2019. So these facts tip the balance more to France. It could be argued that the tax domicile is in France. However, as we have seen, there's not an obvious one permanent home available to her, so that we move on. And now the center of vital interest, according to Article 4, Paragraph 2, second alternative, is deciding. The center of vital interest is defined as the state where the personal and economic relations of the individual are closer. But according to the OECD commentary, the circumstances must be examined as whole. So the family, the social occupations, the political, cultural, and other activities, the place of business, the place from which he administers his property, everything must be taken into account in order to determine the center of the vital interest. But special attention has to be paid to his personal acts. So when we're looking at what speaks for Russia, Mrs. Wells bought and rented an apartment over there, and she lived there for 5.5 months. But she also moved her family there. So this is a very weighty argument for Russia, because as we saw just before, the personal acts are weighted more, and there must be special attention paid to that. But there are also a lot of arguments that speak pro-France as a center of vital interest.
For
Such as?
pro-France, so for pro-France, according to the commentary on Article 2 of the OECD Convention, if an individual sets up a new home in another state while keeping their house in the environment where they have always lived, worked, and has family and possessions, can go to demonstrate that they have retained their center of vital interest in the first state. As we know, Mrs. Wells has retained her in Mrs. Wells' case, her apartment in France, and she has lived a total of 197 days in France in the fiscal year of 2019, whereas in Russia she's only lived there for 5.5 months. And she's French. Her political interests are there. Her familiarities are there. And in the commentary, as Aliza mentioned, when it comes to vital interest, at the end, they look at the personal acts of the individual themselves. And according to Mrs. Wells' personal acts, not keeping in mind the family and all, her personal acts of retaining the home, going back to France, having a professional business, going back for professional purposes, the balance for the purposes of tax tips towards France more than Russia. And the commentary also touches upon where the employer is and who the employer is. And in Mrs. Wells' case, the main employer is in France. In Russia, it's just a permanent establishment, and she is being paid by or on behalf of the French employer. So again, this tips the balance towards France in this point in time for the fiscal year of 2019.
So there are two clear centers of vital interest. So then the habitual abode, according to Article 4, paragraph 2b, is decisive. This criteria tips the balance towards where he stays more frequently. But in her case, it's only 5.5 months in Russia and 6.5 months in France. So she's spending only 1 month longer in France than in Russia. So it would be very, it is debatable that she's this criteria tips again towards more balance towards France. But it would be a very formal view solely regarding 1 month longer stay in France. So it comes down to the nationality criteria in Article 4, paragraph 2c. And Mrs. Welsh is a French national. So in either case, it doesn't matter which alternative we're applying, it comes down to the taxation in France.
So finally, after discussing the domestic tax code and the OECD convention, we will now have a look at the tax treaty between France and Russia. Mrs. Welt will eventually fall under the scope of this treaty, and since it's a bilateral treaty, it will triumph over the ones we've discussed before. So the relevant article in the treaty is Article 4, which has the same wordings as the Article 4 of the domestic tax code. So just to cut it short, it will eventually come down to Mrs. Wells' nationality, which is French, thus making her liable to pay tax in France. And moving on to Article 15.
So, however, according to Article 15, she may be also taxed in Russia because she exercises her employment in Russia. But paragraph 2a makes an exemption because she has not been present in Russia for more than 183 days in a continuous 12-month period within one fiscal year, because she only stayed for 5.5 months in Russia in 2019.
And then finally, according to Article 15(2)(b) of the treaty, and as discussed in the commentary also, Mrs. Welt is paid by or on behalf of her French employer, who is of course French and a resident of France, and they operate from France, but they have a permanent establishment in Russia, just a branch. So to conclude, according to this bilateral treaty, Mrs. Welt's income for the fiscal year of 2019 will be taxed in France for this time and for right now, for just this year. So maybe next year it will be different.
Thank you.
Thank you.
Thank you so much. That's pretty good. The articulation of the reasoning is pretty convincing. I'm not sure we share the conclusion, but this is the beauty of the exercise, and we'll discuss a bit further which kind of comment we could make. But the overview is pretty convincing. You have not discussed one point, which is the Russian domestic rules. But of course, you're not supposed to be a specialist of Russian taxation rules. But just to keep that in mind, in balance, you've got indeed French tax residency, and at least as from March 2019, a Russian tax residency in accordance with Russian domestic rules. You're not supposed to know the rules, but you can reasonably assume that by exercising an employment position in Russia, having his a permanent home in Russia and having his family in Russia, there is little doubt that Mrs. Wells would indeed be regarded as a Russian tax resident for Russian domestic rules, irrespective of the double tax treaty. Just an observation. And maybe another one before leaving the floor to Thomas. When you discuss the period where Mrs. Wells was supposed to be located in France versus Russia, you took the view that indeed you've got in front of you two periods, 6.5 and 5.5 for the whole calendar year. You may keep in mind that the appreciation of tax residency for individuals does not necessarily fit with one calendar year. I mean by this that it is perfectly possible to split a calendar year into two periods where the person, because of fact pattern, because people are moving or are changing their life, and they are not doing so on 1st of January every year. So it is perfectly admissible. And by the way, that could be the way of thinking in accordance with French tax rules, that we will differentiate two periods during the same calendar year, which is from 1st of January to March. Mrs. Wells is no doubt a French tax resident in accordance with French domestic rules, and there is no Russian ties, during that short period of time. So there is no question of applicable of a double tax treaty for this period of time. She is just French tax resident from 1st of January to March. 1st of March. And then for the second part of the calendar year, indeed, you've got this issue that you have perfectly described, that indeed, in accordance with French domestic rules and Russian domestic rules, Mrs. Wells would likely be regarded as, respectively, French tax resident and Russian tax resident. So you will need to go through the double tax treaty and the tiebreaker mechanism in order to determine in which of such jurisdiction Mrs. Wells was supposed to be tax resident, but not for the whole calendar year, just for the period from 1st of March to end of the year. That's okay?
Yeah.
Yeah.
And this is pretty interesting because indeed, you immediately see that simply counting the number of days, as a lot of people, are making the view, which is wrong, that in order to assess where you are supposed to be tax resident, it is just sufficient to count the number of days. You immediately see that this is a nonsense. This is just an urban myth. There is no reality behind that, because the number of days spent in Russia or in France for the whole calendar year does not determine anything with respect to Mrs. Wells. Just because, we've got this separation between the first sub-period, 1st of January, 1st of March, and the second sub-period, 1st of March and end of December. And, if you count the days for the second period of time, which is not the way to do, but just if you were to do so, you will immediately note that for the second period of time, she is spending more time in Russia than in France. So that's totally reverse, the way you should look at the case if you were just, looking at the number of days spent in country A or country B, in France or Russia. Okay, but of course you have not done so. You have, well described the way you have first to look at the definition of, a permanent home available and so on and so forth, each of the criteria. But in order to make this, let's say, fact pattern analysis in a proper way, you will have to do so just for the second period of the year. But everything you described with respect to these tiebreaker rules was broadly correct. But just do not forget that. Just apply that for the second period of the year, because for the first period of the year, there is no doubt this person is not Russian tax resident. This person is a French tax resident, and there is nothing that could prevent that.
Just a question,
Please.
but according to just for your view, but according to, for example, Mrs. Wells' personal acts, would what would you say for that? Because she maintained her house there. She goes back for business. I mean, we don't know if her family comes back and forth with her, but of course, logically, if they've moved to Russia, the children are probably going to school, and the husband's also probably there, so they won't come back and forth every time just for work purposes. But just the individual's acts, just to determine on that, what would you say for that? Where would her center of vital interest
You know,
be?
the case study is, as life is, ambiguous because
Yeah.
usually people do not act straightforward way, just
Yeah.
as a double tax treaty would like they are acting. So putting apart the first period of the year, okay, just focusing on the second period of the year. So as from 1st of March, this person may indeed probably be regarded as Russian tax resident for Russian domestic rules. And there is little doubt that just because of his profession, or profession, and the links with France, she would still be regarded as a French tax resident for French domestic rules purposes. So indeed, as you perfectly described, the only way to settle that contradiction between two domestic rules appreciation would be to go to the treaty. Yes, please, Thomas. No, you were. Oh, sorry, I was interrupted.
And then you would have to discuss Article 23, because then you have the double taxation.
The double taxation.
No, not yet. No.
Okay.
I was just saying that for French domestic rules and Russian domestic rules purposes, this person would be regarded as respectively French tax resident and Russian domestic tax resident according to respective domestic rules. And this is because of this double tax residency, which is not admitted, international taxation rule, that you have to go to the double tax treaty. And that would be indeed Article 4 of the double tax treaty between France and Russia, which would make the determination, and which would make the determination final. Just with respect to the tax residency, I'm not speaking about where the salaries are supposed to be subject to tax. I'm just discussing tax residency, okay? And you perfectly make this two-step approach, first discussing the tax residency, and then, after having discussing the tax residency, and based on conclusion, on this first step of the analysis, you go to where the income should be subject to tax, which are two different questions.
Yeah.
And you perfectly handle that. Just coming back to the first key pillar, which is where this person should be supposed to be tax resident in accordance with the double tax treaty. The case indeed is mixing, several aspects of the personal life of this person in a way which make, any definitive answer to that particular question in accordance with Article 4.2 of the double tax treaty pretty tough. But, yeah, Thomas, you?
No, I was thinking that maybe we can go through the various criteria.
Yeah, indeed,
set out.
Indeed. So we take back, your analysis, and we just make observation on your analysis. First, on this application of Article 4.2 of the double tax treaty.
So indeed, that the first criterion is where and if the taxpayer has a permanent home available to him. And so you rightly mentioned that indeed, so Mrs. Wells has an apartment in Russia, and it's irrelevant whether the apartment is rented out or whether she buys the apartment.
Your voice is breaking, sorry.
And she also made an apartment and
the connection was pretty bad. I suspect that.
I'm sorry, connection.
Your voice is breaking. We can't hear.
Yeah, we cannot hear you.
Yeah, so I think I'm having some connection trouble.
That's better now.
Yeah.
Please
Okay.
go ahead.
Sorry. Yeah, so indeed, so on the first criterion, it's quite clear that Mrs. Wells has a permanent home available to her, both in Russia and in France. So then we need to move to the second criterion, which is the center of vital interest. And indeed, the reasoning was correct in the sense that she has a family with her in Russia, but the employer is in France, and she is paid by a French employer. So it means that we have the personal relation in Russia, but we could have some argument to consider that we have the economic relation in France. So we are likely in a situation in which we cannot define where is the tax residency on the basis of the center of vital interest. Then we indeed need to move to the third criteria, which is the habitual abode. And on this one, as I mentioned the last time, you need to assess the situation, and you need to take the whole picture. And you need to consider the situation of the taxpayer, maybe not only in relation to the relevant calendar year, but by taking a longer period of time. So I'm saying that because the fact pattern says that Mrs. Wells has been seconded to Russia, but we don't know for how long. So we know that before that she was living in France, and so it was her habitual residency. But we don't know that maybe during the next calendar year, she will be moving back to France, and she will continue to live in France on a regular basis. But maybe also she will stay for a longer period of time in Russia. I mean, we do not have such information, and so our view is that it will be quite complex to take a definitive view on where is our tax residency on the basis of such criterion. So it is likely that she has an habitual abode in France and in Russia. So we next move to the last criterion, which is the nationality. And with this one, it's quite simple. She is a French national, so we should consider that her tax residency is in France.
That's okay?
Yeah, yeah. Also, like I think we didn't have the Russian tax treaty, like the domestic treaty for the material, so we just went through it. I think that also came down to the number of years, so that's why we emphasized on that. But this was the final determination that we came up with, that it will come down to her nationality. Because we can't tell the habitual abode where it is. But just for the fiscal year of 2019, for this point in time, we thought it would be France too. But maybe next year, depending on if she moves back to France or if she stays in Russia, because she did buy a luxury apartment, so the intentions might be to stay a bit longer. But then again, she has her house in France also, so we're not, as you said, it's ambiguous. So just for this year, we also determined that it would be France. That was also one of the factors why we said France.
Yeah, no, it's absolutely correct, indeed.
Yeah, and indeed, this assessment will have to make year after year. So the circumstance that Mrs. Wells should be obligated for the second part of the year 2019, a Russian tax resident, or a French tax resident, sorry, in accordance with Tiebreaker rules, will not, preclude any future conclusion for 2020. You will make a further assessment in 2020 based on the fact pattern that will be the one of 2020.
Yes.
And indeed, you're perfectly right, Mariam. It is possible that we will shift from a French tax residency to a Russian tax residency in 2020, depending on evolution of the fact pattern. Okay, that's for the tax residency itself. So despite the ambiguity of the fact pattern, it is likely indeed that the conclusion of the analysis would be that for the second part of the year 2019, so from 1st of March to end of December, Mrs. Wells, because she is national at the end of the analysis, that is clearly not the first criterion, Mrs. Wells would be regarded as a French tax resident for the second part of the year in accordance with the double tax treaty. Now, coming to the second part, second step of the analysis, which is indeed where Mrs. Wells' income should be subject to tax, which is a different question. Okay, so the key point is that we know that she is receiving wages, salaries. Okay, and as a French tax resident, you may remember that you're not supposed to know French domestic rules, but as a matter of principle, as in almost all countries, when you are a French tax resident, you are subject to tax on a worldwide basis, which means that in accordance with French domestic rules, there is no doubt that the salaries would be subject to tax in France. But indeed, you have to look to the double tax treaty because it is likely that because for the second part of the year, 2019, because she is carrying out an employment activity physically in Russia, the Russian domestic rules would consider that irrespective of where Mrs. Wells may be tax resident, because she is carrying on a salaried activity in Russia, her wages should be subject to income tax in Russia. So indeed, you will get two different countries, France and Russia, who, irrespective of where Mrs. Wells is tax resident, but would consider that for the second part of the year, her wages should be subject to tax, respectively, in France and in Russia. And indeed, the Article 15 of the double tax treaty would help you to determine which country is entitled to levy taxes on such employment income. And maybe, Thomas, you can continue on the analysis of Article 15 that you had perfectly started.
Yeah. So indeed, so if you look at the first paragraph of Article 15, the general principle is that the salary income will be taxable in the state in which the employment is carried out. So when you look at this first paragraph, indeed, you will arrive at the conclusion that since Mrs. Wells exercised its employment in Russia, her salary income should be taxable in Russia. So, and this is indeed the conclusion at which you arrived, and this is correct. Now, if we look at the second paragraph of Article 15, you will see that the situation can be a bit more complex. So we, irrespective of the conclusion at which we arrived at the first paragraph, the purpose of paragraph 2 is to say that even if the employment is carried out in Russia, the salary income could be taxable in France. And in order to arrive at that conclusion, you need to go through various criteria which are cumulative and not alternative. So the first condition is that the individual should not, which is a French tax resident, it was the conclusion of our previous analysis, should not spend more than 6 months in Russia. And so, as Vincent mentioned, you remember that you have to split the year into 2 different parts. And so for the second part of the year, so from 1st of March to end of December, if you count the days, you will realize that Mrs. Wells spent less than 6 months, so less than 183 days in Russia. So the first criterion is fulfilled. The second one is the remuneration is paid by or on behalf of an employer who is not a tax resident of the other state. So the remuneration should be paid by someone who is not a Russian tax resident, but a French tax resident, which is the case in our situation because we specified that indeed it's the French employer who continue to pay the salary income to Mrs. Wells. And the last condition is that the remuneration should not be borne by a permanent establishment of the employer in that other state, so in Russia. And on this one, indeed, we could consider that it is true that the salary income is indeed effectively paid by the French employer, but since the activity of Mrs. Wells is carried out in Russia, this is an expense that should be borne at the end by the Russian permanent establishment of the French employer.
If you remember the discussion we had last time, at the time, you have to assess the taxable income of a permanent establishment. You are supposed to attract expenses that are directly related to carrying on this permanent establishment to the taxable income of such permanent establishment. And what is explained in the case study that Mrs. Wells is supposed to manage the Russian permanent establishment. So there is little doubt that her salaries would be allocated to the permanent establishment in Russia of the French employer. This is typically a question that, as a counsel, you would ask your client to confirm, because you're not supposed to have a proper understanding, of all the management of tax affairs of the French company with the employer of Mrs. Wells. So, as a counsel, you will need to ask confirmation from your client that indeed her remuneration is included into the taxable basis of the Russian permanent establishment of a French employment and employer. And if indeed this is the case, assuming this is the case, as mentioned by Thomas 2 minutes ago, since A, B, and C of little 2 of Article 15 are cumulative, that's only where each and all of these conditions are met, that indeed you are you can apply this article. You will note indeed that the last condition will not be satisfied. Assuming your client is confirming you what would be the reasonable assumption, which is that her employment salaries are taking as an expenses for the purpose of computing the Russian permanent establishment taxable income. Which will mean that, if you cannot apply Article 2 because you do not fulfill each and all of the condition of little 2, that will mean that we come back to Article 15.1, which is indeed that the wages should be subject to Russian individual income tax for the reason that the employment activity is carried on Russian territory. For the second part of the year, I'm just speaking about the period from 1st of March to end of December. So you will be in a situation where a French tax resident for the second part of the year, the French tax resident, because this is the conclusion of first step of your analysis, a French tax resident would receive employment income in respect of an employment activity carried on the Russian territory and which is subject to Russian income tax. So Mrs. Wells would pay, Russian income tax on such income in accordance with Article 15.1 of the Double Tax Treaty. But you remember that as an individual and a French tax resident individual, Mrs. Wells would be subject to tax on a worldwide basis in France. So you are facing a typical double taxation issue because, in accordance with the treaty, so this is not contradictory with the treaty, just in accordance with the treaty, this person would be subject to tax on the same income in France and in Russia. So in that case, what are you doing? You're going to Article 23, elimination of double taxation, which is the last step of your analysis. And what will you find in this Article 23 with respect to elimination of double taxation? So we are speaking about a person who is French tax resident receiving income, salaried income, which has been subject to tax in Russia. So when you go, you remember, that in the elimination of double taxation provision, you've got always two entries in respect of France double taxation and in respect of Russian double taxation. In that case, we will not be interested with the second part, which is in respect of Russian double taxation. The reason for that is that the country who has to eliminate the double taxation is the country of tax residency. So it is not for Russia to eliminate the double taxation. Russia is perfectly legitimate to raise personal income tax on the salaried income received by Mrs. Wells for the second part of the year. But since in accordance with French domestic rules, the same income would be subject to French domestic income tax, that will be for France to eliminate the double taxation. So you would apply section 1 of Article 23. In respect of France, double taxation should be eliminated as follows. And then, as you may remember, we have discussed that last time, there are broadly two methods to eliminate double taxation, which are either the exemption methodology or the credit. The exemption methodology would mean that the double tax treaty would impose France not to levy any tax on such wages. And you will see that this is not the case. You know, if you go through little a of section 1, you will see that the income derived from Russia, which may or is taxable in France, shall be taken into account for the computation of French tax, provided the recipient is a resident, France indeed, and that such income is not exempt from corporate income tax. It is not relevant because, you know, this is an individual, so an individual is not subject to corporate income tax. And the next sentence is pretty clear. In such case, the Russian tax shall not be deducted from such income, and the recipient shall have the right to credit. So this is not an exemption method. This is a credit method, okay? Which will mean that such income for the second part of the year will be subject to tax in France. So a French personal income tax will be calculated applying, you know, the French domestic rate and so on and so forth, whatever. So you will calculate an amount of tax, but Mrs. Wells will be entitled to a credit, and such credit will be used to pay such French personal income tax. And the little a of section 1 of Article 23 would say you what would be the amount of such credits. You may remember that basically you've got two ways to assess the amount of a credit, which is, you know, either this is the Russian withholding tax paid at source, or this is indeed, either this is a French income tax, or, so that totally eliminates, you know, the French taxation, or this is a Russian tax, but capped to the French tax, personal income tax, which is corresponding to that income. And you will note indeed that in that particular case, you've got Roman 1 and Roman 2. Roman 1, you know, for all income not mentioned in subparagraph 2, the amount of the French tax attributable to such income, which will mean that in order to know whether you can apply Roman 1, you need first to go to Roman 2 in order to determine whether your particular income is treated in Roman 2. And you will see that in Roman 2, you have a reference to employment income,
Yeah, but
only in respect to paragraph 3 of Article 15. And paragraph 3 of Article 15 relates to the remuneration of, you know, shift or aircraft operated in international traffic. So this is not relevant for the analysis because this is not the case here. But to the contrary, you know, a standard salaried income in accordance with subparagraph 1 of Article 15 is not explicitly mentioned in Roman 2, which would mean that, because it is not explicitly mentioned, you will apply Roman 1, which is for all income not mentioned in subparagraph 2, the amount of the French tax attributable to such income. Which will mean indeed that Mrs. Wells will be entitled to a full credit, which is, you know, you will make the determination of the French personal income tax, which is attributable to such income, but you would allocate a credit which will be equal to such French personal income tax, eliminating, you know, by netting the two, any residual French income tax on such income, which will mean that at the end of the day, for the second part of the year, 2019, the final costs, the final tax costs borne by Mrs. Wells will be the Russian one, because, you know, the Russian personal income tax would have been paid in Russia. And at the end of the day, because of this allocation of a credit equal to the French personal income tax, Mrs. Wells would not suffer any final French tax liability on such income. But just not to complexify too much, but just for you to keep that in mind, as you probably be aware of, in a number of countries, the income tax for individual is determined on the basis of progressive rates, which means that if you receive a small income, you're not subject to the same tax rate that if you receive a significant income. Meaning that, because you may remember that Mrs. Wells, from 1st of January to 1st of March, used to receive French employment income. The rate she would suffer of French personal income tax, she would suffer on such French income tax for the first part of the year, would be influenced in a way by the Russian source remuneration. Because, from a French tax perspective, what we will do, is assessing the total amount of income tax payable in respect of 2019. So aggregating the first period and the second period, because you're not paying taxes on two different periods of a calendar year. You are paying taxes on the whole calendar year, which will mean that at the time of assessing the amount of the tax, not discussing the tax residency, and just assessing the amount of the tax, you will take together the whole period. And from a French income tax perspective, you will add the French source income and the French Russian income. You will make an assessment of what would be the French income tax payable in respect of such global amount, which will mean that you will take into consideration the Russian source income to assess the rate of taxation, the average rate of taxation of Mrs. Wells. And then, indeed, you will deduct from such French tax liability the Russian tax credit, the credit against the tax which has been paid in Russia, and which will be basically the amount of the French tax corresponding to such income, but just for the second part of the year, which will mean that for the first part of the year, Mrs. Wells will continue being subject to French tax. But the rate of personal income tax she would suffer would be influenced by, the circumstance that she has received Russian source income for the second part of the year, which has been subject to tax in France, the amount of such tax being eliminated by the credits. So, of course, you were not supposed to make the last part of the analysis because this is purely French tax rules. But when you have to provide an advice to an individual in respect of a possible double taxation issue, you need to go through all these routes, which is indeed assessing the tax residency, then going through the peculiar provision of the treaty dealing with the nature of the revenue which is at stake, which are the salaries in that particular case. And then if you are facing a double taxation, going to the elimination of double taxation provision, step 3. And assuming indeed you are a French tax counsel, you will continue your advice by explaining to Mrs. Wells the way she will be subject to tax in France for 2019, and in a more detailed discussion on how her tax liability will be calculated. And with this articulation and this series of steps in your articulation, you will have provided a full and satisfactory advice to Mrs. Wells.
One question.
Yes, please.
I didn't understand one thing. So for the first part of the year, it's France,
yes,
right? And the second part is Russia. So for the first half of the year, the tax will go to France.
Yes, indeed. Yeah.
And then for the second, it'll go to Russia.
You're not paying tax to a worldwide organization which allocates the tax in both countries. You're paying tax directly to the tax authorities.
To the countries, yeah.
So for the first part of the year and the second part of the year, Mrs. Wells will be subject to French tax liability. If you take a national approach now, French tax authorities or Russian tax authorities approach, that would mean that in the eyes of the French tax authorities, this person should be subject to tax on her wages for the total amount for 2019. Okay, so the French tax authorities will calculate an amount of tax on the basis of the whole wages, the whole amount of the wages for 2019, but they would allocate a credit just for the second part of the year, 1st of March, end of December, a credit which would be equal to the French personal income tax suffered on the Russian source income.
Okay.
Which will mean that, if you make a broad computation, that will mean that at the end of the day, in respect of France, the final tax cost of Mrs. Wells would be solely with respect of the French source income of the first part of the year. Because, with this way of computation of a credit, she at the end of the day, she will not pay tax to France in respect of revenue income for the second part of the year because she will use a credit to pay the tax. So you will not make a cash payment to the tax authority because you are using a credit to pay the tax. And from a Russian tax authority's perspective, the Russian would totally disregard the first part of the year. They are not concerned at all. They would just, assess Russian tax liability for the Russian source income for the second part of the year, using, the local rates and so on and so forth. So we will not discuss that. But Mrs. Wells would indeed suffer Russian tax liability, final Russian tax liability in Russia, in respect of the second part of the year, the income for the second part of the year.
Is the year always decided in two parts for tax purposes?
No, they depend on the fact pattern, but this relates to the particular circumstance, which is the following: the tax residency of Mrs. Wells first may have changed on 1st of March. That's the first point, which explains that indeed you may have to make a breakdown of the two parts of the year, because if at the end of the analysis you had to conclude that Mrs. Wells were becoming a Russian tax resident, she would not have become a Russian tax resident as from 1st of January. She would have become a Russian tax resident as from 1st of March. Okay? That's the first explanation. The second one is in respect to the salaried income. She has not received any Russian source salaried income from 1st of January to 1st of March.
Yeah.
So from 1st of January to 1st of March salaried income, Russian has nothing to do with that.
Yeah, okay. Mm-hmm.
Russian will even not be aware that she had received any such income for such part of the year. Okay, which is the reason why indeed we make a split because of this particular fact pattern.
Okay, yeah.
If the fact pattern had been that Mrs. Wells has started her Russian employment activity as from 1st of January, we will not have split the year into.
It would have been like a mix from the beginning of the year that she moves back and forth from the beginning to the year. We have had our picture, Mariam and I described, but since she is on block state till March in France, it's this way. Okay, yeah, okay. Yeah. Thank you.
Okay.
But we're taking the whole year into account and we're just splitting the times she has spent in both the countries and then dividing it accordingly. But we have to take the whole year into account, when you're calculating, right?
When you calculate the tax liability, but this is the last stage of the analysis.
Okay.
when you say, when we say calendar year, first, this is to make a distinction, to make very clear that we do not mix, you never mix 2 calendar years. This is as a rule of thumb, never mix 2 calendar years. So in any case, an assessment has to be made year after year. And the tax position of 2020 will not be decided by the tax position of 2019. This is as a rule of thumb. Okay? But within 1 calendar year, depending on the fact pattern, you may have indeed a change of tax residency during that calendar year, as from a certain point in time. So in other words, you're not necessarily tax resident in 1 single country for 1 calendar year. You may perfectly have 2 successive tax residencies in 2 different jurisdictions in the same calendar year, not at the same time, successive. So you may perfectly be a French tax resident for 1st of January to end of February, and a Russian tax resident from 1st of March to end of December. And you have to make this tax residency analysis by dividing the 2 periods within the same calendar year when the fact pattern commands to do so. Again, if Mrs. Wells had moved to Russia as from 1st January and started her employment activity in Russia as from 1st of January, we would not have divided the calendar year between 2, parts. Okay? This is the fact pattern that commands that. But indeed, once you have made the whole process of assessing the tax residency, determining which country is entitled to levy particular tax on particular category of income, which is employment income here, and what would be the way to eliminate possible double taxation. So after this whole analysis, when you come back to how to assess taxes in France, I say in France because she is tax resident in France, for the whole year. This is your conclusion. So when you come back to the last step of the analysis, indeed, you will come back into a situation where, as in the vast majority of the countries, we are making an assessment of your tax liability for a calendar year. So in order to assess the amount of the tax payable, you're not subject to tax for a sub-period A and a sub-period B in the year. You are subject to tax for the whole calendar year in France. So at that point in time, indeed, you come back to taking into account the whole revenue of that person for the whole 2019 calendar year. Okay, you see, so this is the reason why, assessing the taxable income of individual is pretty complex when you compare to assessing, the amount of taxable income of a business sometimes. These are different complexities, but you have this back and forth analysis to be done between several steps, and several countries. And you're not necessarily taking the same angle at each step. You see? But you have perfectly understood the reasoning. The proof is that you have made this reasoning, in the right way, which is assessing the tax residency, then discussing, after having assessed the tax residency, discussing how the employment income should be taxed. At that point in time, your conclusion diverged from the one that you have made, because you missed the point that in respect of Article 15, Section 2, you need 3 cumulative conditions. And indeed, in the last one, you had this trick that the reasonable assumption should be, but to be confirmed by the client, that the employment should be an expense of the Russian branch. So that Russia was entitled to levy tax, and because Russia was entitled to levy tax on that particular income, you were facing a double taxation issue, which oblige you to go to Article 23. Okay, you see the point where you made this conclusion that prevents you to go to
We
end of the
confused
amendment.
the alternative, the word alternative, maybe.
Yeah,
with the-
exactly.
Yeah. Like, but we had to it was like the whole of the test.
Exactly, that was cumulative. You've got an end.
Okay.
In the treaty.
Yeah.
But that was the sole reason for you to just diverge, at the last moment. But which is this is why the international taxation of individuals is pretty exciting. That you will immediately see that you've got a series of crosses, over your road.
Yeah, because yesterday
you may
we
make
were
a misstep at each of them.
Yeah. We were wondering how we can talk about Article 23, but then we, because of our conclusion already, we didn't know how to. So now it makes
Exactly.
sense. Yeah.
Exactly.
Thanks.
So you had the feeling that something was possibly wrong, but it was difficult to assess where exactly in the reasoning.
Yeah.
Okay.
I have a
but
question.
apart from that, that was excellent.
Thank you.
Thank you.
I have a question regarding the wording of Article 15, if you can go back, just because, yeah. Okay, so it says, shall be taxable only in the first mentioned state if, and then it has the 3 points. So unless it's stated otherwise, we should assume that when the articles are worded like this, it's cumulative, right? That we have to include all of the numbers, all of the points.
This is the end.
Yeah, because you have the word "and" at the end of the little a and little b.
Okay.
And so
Not or,
and.
Yeah. Otherwise, you will have or.
Okay.
That's.
Thank you.
Just a choice. But in that case, that was end. And this articulation of subparagraph 2 of Article 15 is not unusual. This is typically, almost OECD-like, treaty, the French European one. So this is not peculiar to that double tax treaty. And I will not enter into too complex consideration, but if you think about what is the rationale of that, just taking some light for 1 second, what is the rationale for that? Is that, if the remuneration is taken into account for assessing the taxable income of the permanent establishment in Russia, that would mean that, in a way, Russia, the Russian government, has already suffered a deduction of taxes, because at the time of assessing the amount of the corporate income tax payable in Russia by the French employer, on the taxable income of the Russian tax permanent establishment, the remuneration has been deducted as an expense, which means that Russia, as the Russian government, has already according a kind of allowance, if you see what I mean, by accepting that this income is deducted. So if on top of that, the Russian government were accepting that it is not entitled to levy any personal income tax on such income, that will mean that, if you make the balance, Russia would have allocated an allowance of taxes to the French employer through the permanent establishment. But in the meantime, that would be the French government which first, receive the income tax, and second, have not granted any allowance in respect of such expenses for corporate income tax purposes, because if the expense has been taken into account in Russia, that will mean that the expense is not deductible in France for the purpose of assessing the corporate income tax of the employer. Okay, so I'm not saying that you have that in order to address the position of the individual, you have to make this reasoning. I'm just explaining you, or trying to explain you what would be the rationale for two countries to agree on such kind of provision, This is not just foolish, this three condition. There is a direction, behind that. Is that, it would be pretty unfair, frankly, to leave Russia according a tax deduction on the amount of the Russian corporate income tax, and at the same time having France levying taxes, individual income taxes on such income, without according or granting any kind of a deduction. So that would be unbalanced, and at the time of negotiating such kind of double tax treaties, because apart from certain certain income or specificities where there is clearly a commercial unbalance between two countries, but when speaking about employment wages, country A and country B are exactly in the same position. There could be, as much French tax resident going to Russia and, having some employment position there, that you could have Russian tax resident going to France in order to exercise the, professional activity. So there is no particular reason for one of the two countries to fear that it would have a particular advantage or disadvantage, which will mean that they will, for this kind of provision of employment, usually they will try to find a way to allocate tax which is globally fair. And this is the reason of this, subparagraph 2 and the 3 condition of the in particular, the last one, the remuneration is not borne by a permanent establishment in Russia. Okay, you see that just a rationale, that's not law, that just, to help you to understand why we land to applying such kind of a weird, condition. But this is not weird, this is not foolish. That makes perfect sense when you think about, globally, the allocation of taxes between two countries negotiating a double tax treaty.
Yeah.
Question, just in practice, given that you guys are practitioners, what does this look like in practice? It seems like an incredibly complex thing for an individual to have to deal with in terms of dealing with double taxation between two countries. Like when you're advising a client, what are the, do you speak directly with the accountants at their company to understand where they're receiving their employment income? Do you request the documents? I'm more curious about that because I don't know, I just have more questions about that the more we go through this treaty.
In the real life, in a very practical way, when an employer in a multinational organization is asking an employee to move abroad, this is part of an, let's say, international mobility program. And if you want to incentivize your employee to go abroad and taking responsibility abroad, from the, let's say, tax jurisdiction, initial tax jurisdiction, you have to assist them. So as part of a global mobility program, usually the employer would provide the advice to the employee, which are, let's say, generic advice, so not necessarily tailor-made to each of the peculiarities of the employee, but basically that will take into consideration, generic advice on where you are supposed to be tax resident, preparing and filing on your account your Russian tax return, and as the case may be, assisting you to prepare your French tax return if you need some help because of, the Russian component of your income for a particular year. And typically, a global employer would ask a Big Four, PwC of the world or whatever, they've got plenty of people in charge of that, which would assist, the company, because the client of the Big Four would be the company and not the person, not the individual, but which would assist the company is providing generic advices to people which are concerned by this global mobility program, and assisting in preparing and advocating, maybe filing the proper tax return in the various jurisdictions where the people were not tax resident before moving. And just to add some complexity on that, but because we are speaking about practice of life, in the real life, on top of providing assistance on preparing and filing tax return, an employer would accept to bear any additional tax costs that the employee would suffer because she is moving outside France. So you will get a pretty complex, trust me, mechanism, what we call tax equalization, according to which at the end of each calendar year, the employer will make a comparison between the global tax that an employee would have suffered if the employee had remained, in his, jurisdiction, for instance, in France. Yeah. So you will make an assessment of what would be the hypothetical tax that the employee would have suffered absent any moving outside France, and the amount of tax that has been actually suffered, as a result of moving outside France. And usually you will get the obligation for the employer, a contractual obligation, purely contractual, to pay to the employee the amount of any additional tax that the employee is suffering because of moving outside France. And you can even have the reverse, which is the obligation of the employee. This is not so common, but in certain circumstances, moving abroad could reduce your tax liability. In particular, if you take the example that you're not moving to Russia, you're moving to, I don't know, any country in the EUA, for instance, where there is no personal income tax. So if you are moving to a country where there is no personal income tax or very little amount of personal income tax, moving to that country would reduce the employee personal taxable tax liability. And usually in such kind of tax equalization system, because the system is balanced, the employee would be obliged to pay back to his employer the amount of tax savings that he or she is making by moving out of France. It is not so common that would work in that way. In the usual way, moving people outside the state of origin would generally result in increasing the amount of the income tax which is payable, and that would be for the employer to pay for the difference. So this is the way it works in the real life.
Thank you. That's helpful.
Sure.
I also have a question about credit. So if I understand correctly, the fact that it's a tax credit is relevant for the progressive tariffs, and otherwise it would be the same effect as an exemption.
Yes, indeed. Yeah. Absolutely.
Okay.
Which is the reason why, we used to say that a tax credit method never fully eliminate the impact of the revenue. At the end of the day, the tax credit method would always leave sometimes a very small amount of additional taxes. But this is not as if the employee will not have received any such Russian source income. Because if that was the case, if the employee had not received any Russian source income for the second part of the year, the rate applicable to the French source income for the first part of the year will be significantly lower.
Okay, thank you.
Okay.
I have a question.
personally, for example, I'm still an employee of Japanese company, but so they sent me here to study in Asas, and I think so. My company still pay to me my salary, so but so my work is maybe exercised in France. So, but in France, my status is just a student. So I'm wondering if I should pay tax in France or not.
Free advice. That's a pretty tough question. And frankly, I'm not sure we will get a straightforward answer for you, in particular because we personally, maybe Thomas have, but I do not have the Japanese-French double tax routine in front of me. But that's true indeed that, if you are to be regarded as a French tax resident for year 2020, just assuming that, maybe for a part of the year, just as from September or October, the question would arise, or should arise indeed, because, becoming a French tax resident, if this is the case, just assuming this is the case, will mean that normally you would be subject to tax on a worldwide basis, which means that if you are receiving income from Japan, it is possible indeed that by applying a provision which would be pretty similar to Article 15 of the French-Russian double tax treaty, you may end up in a situation where France would not be entitled to levy any tax because you have spent less than 143 days in France and your remuneration is not borne by a French permanent establishment of your Japanese employer. So it is possible indeed that by applying this set of rules, you will end up the conclusion that France is not entitled to levy any tax in accordance with the double tax treaty concluded between France and Japan. But I have not personally looked at that double tax treaty, so I would just advise you to do so. Now you know the methodology, you know to apply it. But indeed, if such treaty is concluded in a way which is pretty similar to the OECD model, and absent any French permanent establishment of your employer in relation to which you will be allocated, it is possible indeed that the conclusion would be that France is not entitled to levy tax. So you can perfectly be a French tax resident, but in the same times, France will not be entitled to levy any French tax income on salaried income which relate to Japan and which has absolutely no link to your presence in France. So it is possible, but you will have to make the analysis.
Okay, thank you.
You're welcome. Okay, so time is it 11? Maybe should we make a short pause of 10 minutes and then go through the last case study?
Okay.
That's okay for you?
Yes.
Okay. It's 11, so should we say 12 past 11? We circle back. Okay.
Yes.
At 12.
Okay. Thank you.
Okay. Speak to you soon.